Hey, how's it going? Bill Lethman here for Money Evolution. In this video, I'm going to be talking about modified adjusted gross income and adjusted gross income. What is it? What does it mean? How is it calculated? And why does it even matter? Well, adjusted gross income and modified adjusted gross income are two pretty common tax terms, and you probably have maybe even heard of those before, but maybe you don't really fully understand what they mean and what the potential impact could be for your financial situation or your eligibility for certain programs, or your eligibility, for example, for an Affordable Care Act subsidy or a child tax credit, or what it could do to your Medicare costs. If you're over a certain amount, it can make your Medicare costs go up. So it's a very important concept to understand, and really how it's calculated. That's something I'm going to get into in this video, and what are some of those thresholds, and what are some of those things that you should be looking out for. Well, real quick though, before I get into the content of today's video, if you're watching this and you'd like to learn more about what we do at Money Evolution, head over to moneyevolution.com. We've got some great resources over there. We're building out an entire financial education hub that you can learn about all kinds of different topics. And we also have some programs that we do some financial planning, and we've also got our DIY retirement planning program called the Retirement Time Machine. So head over there. You can learn about all of that there when you get a chance. Now let's dive into the topic here. So modified adjusted gross income and adjusted gross income. Let's start off with modified adjusted gross income. And there's a few things that are going to be very important here. It's going to be used, for example, to calculate an ACA subsidy. Affordable Care Act, that's something that came out. Some people call it Obamacare. But basically, depending on how much income you have, and if you're under certain thresholds, you can actually qualify for an ACA subsidy and get a reduction to that amount of health care. This is something very big, especially for people that are retiring early before Medicare kicks in. Oftentimes with some of our clients, we've been able to help them map out some of their income and keep their income low enough to be underneath one of those Affordable Care Act subsidies. That's something I'm probably going to get into in a lot more detail in another video and talk about what those subsidy ranges are, and really get into the detail of how we structure that. But that's something really big there. One last thing on that Affordable Care Act subsidy for 2025, there's still an expanded amount of that subsidy. They eliminated basically the cliff of that. So now it usually was tied to if you were under 150% of the federal poverty level, you basically had either very, very little cost for your health care, or you even got it 100% subsidized. And then from 150% of that federal poverty level to 400%, you got some kind of a subsidy. And then after 400%, you got nothing. Now with the current rules that were put into place after COVID through 2025, they're actually even giving you a little bit of some of that subsidy even beyond that 400% level. I think that comes in like for a married filing joint tax return, that federal poverty level at that 400% level would be about $80,000 of income. So if you're under that, you could get some kind of a subsidy there. So kind of a really big deal there, and it goes into the planning, especially for those people that are looking at early retirement there. Eligibility for Roth IRA contributions. So this is a big one too, because if you're over a certain income level, you can't make a contribution to your Roth IRA account, at least not directly. We talk about things like the backdoor Roth. That's a different video, different topic there. But for 2025, it's $150,000 if you're filing a single or head of household tax return. And if you're filing a joint tax return, it's $236,000. And again, that's going to be tied to this modified adjusted gross income. I'll talk a little bit more about that and how it's calculated here in just a second. But that's what you're going to use for determining your eligibility for that Roth IRA contribution level. It's also a big deal for calculating something called the net investment income tax. So that was something that was put into place with the Affordable Care Act, and it's going to basically take all of your investment income that you have, dividends, interest, capital gains, even income from real estate investments and things like that, any passive investments. And if you're over a certain threshold, you're going to be assessed a 3.8% net investment income tax on the lesser of the amount that you exceed the threshold, or the amount of your investment income there, whichever is lower there. So kind of a big deal. So that is something that those thresholds were put into place with the Affordable Care Act, and they have not been adjusted for inflation. So for 2025, $200,000 is for single tax filers, if your modified adjusted gross income is over that amount, then you could have some net investment income tax applied. And if you're married filing a joint tax return, that amount is $250,000. And then lastly, kind of the really big deal here is Medicare IRMA. That stands for Income Related Monthly Adjustment Amount. And that's something that if your income is above, your modified adjusted gross income, I should say, is above for an individual $103,000, or you're married filing a joint tax return and your income is above $206,000, you're going to start to have an extra fee basically applied to your Medicare premiums. And that starts off at maybe just a little bit, maybe $75 or $100, and then it can very quickly over double the amount of your Medicare expense. So something to be thinking about as you're putting together your plans, and really kind of what we do is mapping out income and looking at how your income is going to change over time, and are there things or strategies that you could be doing now that could maybe push some of the income out before you get to that IRMA level, so that you can avoid some of that IRMA later on in your retirement there. And also looking at things like RMDs, required minimum distributions, something a lot of people may not necessarily be thinking of, but if you have a lot of money in those traditional retirement accounts, even if you're not going to get hit with IRMA right away, are those required distributions potentially going to push you up into a bracket where that IRMA is going to really become a big deal later on after either age 73 or 75, whenever your RMDs kick in there. So that's why modified adjusted gross income is so important. Let's get into a little bit, some very high level overview on how your taxes are calculated, and then what goes into that modified adjusted gross income, and then we're going to talk about adjusted gross income here as well. So basically, if you look at all of your income, every possible way that you could make money really falls into three broad categories here. We have tax-free income. That's going to be primarily from two sources. It's going to be qualified distributions from a Roth retirement account and tax-free interest from things like municipal bonds. The second type of income is what's called a tax preference income. A lot of people may not fully understand that, but there's actually two tax tables. There's a tax table for what's called ordinary income, which is pretty much everything else. And then for two primary things here, qualified dividends and long-term capital gains, it's going to qualify for a lower tax rate. That's either, depending on how much income you have, it's either going to be a 0% tax rate, a 15%, or a 20% tax rate on those preference items. And then everything else pretty much falls into that ordinary income bracket, and that's going to be where your tax brackets are. So if you think of marginal tax rates, or what those different income levels are, that's all going to be coming in under ordinary income. So it's earnings from your job, net business income, short-term capital gains, non-qualified dividends. A lot of people say, what are non-qualified dividends? Well, this is something that's been getting a lot more attention the last couple of years, because they might have mutual funds or exchange-traded funds that are primarily invested in bonds or have bonds in them. And bonds pay interest income, and that's something that is included here in this ordinary income schedule. But the mutual funds or the ETFs or whatever, they may pay that interest income as a dividend, and because it's really derived from interest, it's classified as a non-qualified dividend. So now that interest rates are up a little bit higher these days, sometimes, getting up in, 4, maybe even almost 5% in some cases there. A lot of people are getting a lot more of that non-qualified dividend income. If you take money out of an IRA account, that's going to be classified as ordinary income. So something to think about there as you're mapping out your retirement withdrawal strategy. And again, that RMD forced distribution that's going to come later on in life. Pension income, your Social Security benefits. Social Security has a cap on how much of it can be taxed. It's currently at 85% is the maximum amount of your Social Security benefit that could be subject to tax. And then again, net rental income and royalties there. So if we look at how your modified adjusted gross income is calculated, basically we're just going to take all of those different things, and then you're going to get a few deductions that are going to come off of that income that are going to end up with your modified adjusted gross income calculation. So in the tax-free category, if you have any Roth IRA distributions, those are not going to be included in your modified adjusted gross income, so those are subtracted. If you have deductible IRA contributions HSA contributions, if you are paying alimony on a divorce that was pre-2019, so divorces after 2019, they changed up who pays the taxes basically on that alimony. So if you're paying alimony on a divorce pre-2019, that gets deducted. Simple plan contributions get deducted. If you're paying self-employed health insurance, so if you have a business and the premiums for that health care being paid out of the business, that can get subtracted. And then if you're a teacher, an educator, if you have expenses for your classroom and things that you're spending money on, that gets to come off before modified adjusted gross income calculation. So that's how modified adjusted gross income is calculated. It is not something you're going to find anywhere on your tax return, but most people refer to modified adjusted gross income as using the adjusted gross income number, which is on your tax return, and then subtracting a few additional things. And I'm going to get into that here in a little bit when I talk about the adjusted gross income. So hopefully that makes sense for modified adjusted gross income. Next, we're going to talk about adjusted gross income, and this is something you can find on your tax return. I should have wrote it down, but I forget what line it's on there, but it is on one of the lines on your 1040. One of those, I think it's on actually both the first page and the second page. I think it carries over. But the adjusted gross income is going to be used for a couple of additional things when they look at the child tax credit. So right now, under the current Tax Cuts and Jobs Act, at least through the end of 2025, we've got an expanded qualification for the child tax credit. So, but they are going to look at that AGI for that. We're hopeful that the tax cuts get extended beyond 2025, but we'll have to see what the new administration does on that. Medical expenses. If you're itemizing your deductions and you have high medical expenses, they're going to have basically a floor essentially. So you're not going to get to deduct any medical expenses until they exceed 7.5% of your adjusted gross income. So if you make $100,000 a year, if you have $7,500 of medical expenses, you don't get to deduct any of that if that's what your AGI is, only things above that. And then work-related expenses, that's going to be very similar. I think that's at 2%. I should have wrote that down as well. But again, it's going to have a floor, so you don't get to deduct anything until you exceed that level if you're trying to write off things that you have expenses as unreimbursed, I should say, unreimbursed expenses as it relates to your job. Stimulus checks, they often look at the adjusted gross income for determining who gets a stimulus check like they did for the COVID stimulus and things like that. And then AGI is also something that's going to go into the Social Security tax calculation essentially. So they're going to look at your AGI. One thing on that just real quick is that the Social Security income tax thresholds, they were set back in the early 80s. They've never been adjusted for inflation. So as Social Security tends to go up most years with the rate of inflation and people's Social Security benefits are getting bigger because they've made more money, put more money into the system, they are more likely going to, almost everybody's probably going to get taxed with their Social Security benefits there. So just a little side note there. Basically, AGI is going to be your modified adjusted gross income with those things we subtracted for the MAGI, and then also subtract the tax-free interest, and then you're also going to get to deduct any student loan interest. So that's qualified student loan interest. So if you've refinanced your student loan with a private lender, probably that's not going to be qualified student loan interest. So something to think about there if you're doing that. Only if you have one of, I think, the government student loan funding programs there would you be able to deduct that. And then if you are self-employed, you probably know you're paying both sides of the FICA tax, the Social Security and Medicare tax. So half of that, which is basically the amount that's paid by the employer, that gets to get deducted as you go into that AGI calculation there. So hopefully that's been helpful. Hopefully that gives you a pretty good idea of how all this stuff kind of fits together, why modified adjusted gross income and adjusted gross income is so important, and especially as you go into retirement where you've got a lot more of those different moving pieces and things, understanding what goes into those things is going to be a really big deal because if you are trying to qualify for some health care subsidies or you're looking ahead to Medicare and hopefully trying to keep your Medicare costs and premiums down, so you're not getting hit with that IRMA, that income-related monthly adjustment amount. Understanding what goes into those AGI, modified adjusted gross income numbers, is going to be critical. So anyway, hope you enjoyed the video. Be sure to like and subscribe to our channel. We're going to continue putting out what I think is really great educational content like this. And then if you would like to learn more about what we do, head over to moneyevolution.com and check out some of the things we have over there on the website. We're continuously adding things to that, and hope to see you over there. Thanks. Have a great rest of your day.